Hello everyone, welcome back to Mutual Understanding. This is Marble. Today is the 16th of March 2026 and we are dissecting China's economic data for the first couple of months of the year. Alright, let's dive in. And spoiler alert, the writing is on the wall and it's looking pretty disastrous. If you study economic history, the parallels we are seeing right now are impossible to ignore. Let's look at the consumer spending at the start of the year of the dragon. Oh wait, this is the year of the horse. Right, the year of the horse. We have essentially hit the lowest point since the pandemic. Now, the headline numbers might claim retail sales are up, but it's all smoke and mirrors. Right now, industrial production in China, specifically the massive export volume, is what's artificially propping up the data. While fixed assets investment is taking a complete nosedive. And this is textbook overcapacity. The government is pushing hard to flood the global market with quote and unquote green tech exports like green power, like wind power, like lithium batteries and solar panels, and it's giving serious 1980s energy. Back then, as you may recall, Japan tried to export its way out of an economic slowdown, which triggered massive global trade wars. And China is running that exact same playbook. As in, they're keeping zombie factories on life support just to churn out volume without actually making a profit or even at its own cost. So why is domestic consumption flatlining? It boils down to a shrinking property market in China and the rock bottom consumer confidence. We're basically watching the wealth effect working in reverse. When people watch their life savings evaporate in real estate, they shut their wallets. And on top of that, the high income earners, the tech workers at giants in China like Tencent and Alibaba, they're facing brutal waves of layoffs. And it's a harsh reality check. Beijing knows domestic demand is the holy grail this year, but bouncing back from the pandemic slump is taking way longer. It's way longer than expected. To offset the bleeding in the property market, Beijing is leaning heavily on exports. But just like we saw the Smoot-Hawley tariffs in the 1930s, aggressively dumping cheap goods globally, that's not gonna work. That's not gonna fly. That is simply going to trigger massive protectionist pushback. And then there is debt. We are looking at 12 trillion in new debt, wrapping into a 30 trillion budget. And they're trying to build their way out of a debt crisis by taking on more debt. To actually move the needle, they need an injection of capital 4 times this size. Right now, the debt is just a massive drag on the system. So next up, let's also zoom in the big three indicators of consumer purchasing power in China, which is cars, smartphones, and real estate. First up, cars. February domestic sales took a 23% nosedive year over year. Exports jumped 48%, but again, the data is heavily padded. A lot of those cars are just sitting in overseas lots gathering dust. Plus, their biggest buyers like Russia and Iran are totally tapped out because of recent circumstances. EVs were supposed to be the saving grace, but the market is stalling. Why? Because the EV boom was an urban phenomenon. Once you move past the mega cities, the charging infrastructure is practically non-existent. What we are seeing brutal price wars of electric cars in China, and a lot of smaller automakers they're going to get completely wiped out this year. Next, the second pillar will be smartphones. January saw a brutal 23% drop. Huawei is hitting a massive technological wall because of global sanctions, reminiscent of the Cold War tech embargoes. They're stuck at the 7 nanometer chip bottleneck, while the rest of the world moves on to 2 nanometer tech. Unless these companies can pivot hard into AI, the smartphone market has officially peaked. And finally, the elephant in the room, property. The property market in China peaked in 2021 and has been sliding ever since. This isn't just a cyclical turn down, this is a structural unwinding. In tier 3 and tier 4 cities of China, we're looking at fast ghost towns that make the 2008 US subprime mortgage crisis look like a minor hiccup. If you can buy a fully renovated apartment in places like Zhuhai for pennies on the dollar, but nobody's biting. Land sales have evaporated completely. I also want to talk about the holiday illusion and the road ahead. You might have read headlines in Chinese news that about the booming Spring Festival consumption. Don't buy it. Yes, spending was technically up 8%, but the holiday was it was a day longer this year. If you adjust for that extra day and factor in the billions in government consumption vouchers, actual per capita spending power is incredibly weak. So, what's the master plan? The government is pouring a staggering 56 trillion with a T, into quote and unquote high tech and new productive forces. It's a classic command economy trap, honestly. It reminds me a bit of the Soviet Union in the 1970s, building massive industrial capacity while the average citizen was completely tapped out. China is staring down three massive long-term headwinds: local government debts that has hit its absolute ceiling, the lingering real estate bubble, and a shrinking population. It's the exact recipe that caused Japan's lost decade in the 1990s. They can't really rely on massive quantitative easing anymore, and with geopolitical tensions rising, this export band-aid isn't going to hold forever. Alright, that's all for today. Thank you very much for listening. If you like this video, hit the subscribe button, like, and comment your nonsense below. I'll see you in the next one.